Hi everyone, welcome to the last episode of the prelude for this series, Market Zero to N. This is probably the most important episode of the prelude, and it's inversing the herd. Now, this is easier said than done because oftentimes the herd mentality is formed for a reason, and the news feeds you a certain narrative to make things look really good. And I want to start with the quote from Reminiscences of a Stock Operator. Stocks are manipulated to the highest point possible and then sold to the public on the way down. Now, when you think of that, you think of herd mentality. Guys, when stocks are rising, it seems like every bad news is swept under the rug and ignored, and every good news is brought right in front of your face, so you buy off Wall Street at the peak. Think about that for a little bit. Now, another one I want to bring up from how to trade in stocks is it would be simple to run down the list of hundreds of stocks in my time which have been considered gilt-edge investments and which today are worth little or nothing. So that quote applied to something like Nokia, guys. Nokia was an amazing company back in the day, and it looked like the future, and today it's a piece of trash and garbage. Now we can talk about plenty of other companies. We can talk about General Electric, Enron, whatever it is. And the fact of the matter, these so-called blue chips, yes, at a certain time they are a blue chip, no doubt, and you can treat them that way. But when you think long-term, think of a stock almost like a human, at some point it's gonna die. And with that being said, people have this herd mentality that long-term investing is actually safer than short-term investing. And I think that is completely false, because long-term investors will make a bet and let it ride, and when they're wrong, they're going to lose it all. Whereas speculators, they might lose some here and there, but they rarely become bag holders for life. So a very different scenario. Now, back to inversing the herd. Look at Yahoo buying Broadcast. Now, you guys have probably not heard of Broadcast, but you've probably heard of Mark Cuban. How did Mark Cuban get so rich? Well, it was from Broadcast. Now, you guys are probably wondering, how is a stock selling for $5.7 billion 26 years ago and losing $16.4 million on anemic sales of just $22 million? Guys, your local restaurant chain probably does more sales than that. And sure as hell doesn't lose that much money. And think about $5.7 billion for that. This was the dot-com bubble. If you had this herd mentality, even Yahoo had this dumb herd mentality, and they just burned all that capital. Many, many examples. People talk about pets.com. Guys, you can't be thinking like everyone else, or you're going to get burned big time. And it's quite a shame that even Yahoo management couldn't figure that out. And one thing to also note, Yahoo at one point was considered a blue chip too, so very, very disappointing. Now, the next one, Great Financial Crisis. This one, people bring up all the time. Warren Buffett has a famous article, and essentially, it's just him saying he's going to buy stocks and be fearful when others are greedy and be greedy when others are fearful. Now, it's very hard to quantify greed and fear. Like, how greedy, how fearful, right? What if you're too early? What if you're too late? So, not the easiest thing to do, but one thing I would recommend is CNN's Fear and Greed Index. Obviously, buying in its so-called extreme fear and selling in its so-called extreme greed probably doesn't work very well. But I can tell you for certain, if you bought every time that index was at a fear level less than 5, you would have made a huge amount of money in a pretty short period of time. So, just that general principle is pretty good. The next thing, COVID. Bill Ackman is crying. We have, everybody's saying that everybody's getting sick, people are dying. That's true, but the market didn't care. You gotta sometimes ignore what's happening in life, ignore your biases, and think, so people are dying, is that bearish? Not necessarily, right? And like, it sounds kind of bad to say that, but when it comes to the market, even the most bad and disgusting, unfortunate things could be bullish. So unless you want to donate your money to Wall Street, you got to think against the herd, really, and eliminate your biases. Now, it would be wrong if I told you all this and act like the herd never wins. Now, I can't say Apple has been a consensus since 1985 or anything, but I think, since the iPhones and such, at least after a few generations out, this has been a pretty consensus blue chip, and it's kept really running. Do I think that's going to happen for a long amount of time and keep going forever? No, I still don't think that, but I can't say the herd doesn't win sometimes because, you could have had a good decade in this. So even if you end up losing later, as long as you, took some profit before the tide turned and got out, you'd be fine. But another thing I'd like to mention, and these come from a book called Best Loser Wins, is in order to get what you want, you need to think like the 1%. And in fact, you don't even really need to think like the 1%. You need to not think like the 99%. And I just said Apple was the consensus, right? So the 99% are probably thinking this is a buy. But you know what? If I go back to, the millions of people who own this stock, how many of them can say they've held this for 2 decades? Or, even a decade or maybe even 5 years? Probably not a lot. And how many of them can say they haven't sold a share? Even less, right? Now, 99% think that when they start to win, they should start betting less. But in reality, they should start betting more, right? And when people are on a winning position, they start thinking, oh, where should I get out? Where should I take profit, right? How many people with Apple in the last 10, even I guess 5 years, they're making money, they're good, and instead of selling or holding their shares, they're actually adding. I would imagine this is probably the least percentage. So, if you want to inverse the herd and inverse the 99%, sure, like Apple was a consensus pick, but when everybody's taking profits and selling, I highly doubt people held this that long. Maybe, just maybe, you should think about adding more to your winning trades. And, this is not really, this is really not like too complex of a philosophy. A lot of people will say it in different ways, cut your weeds, water your flowers. And a lot of people will sell their winners and buy losers, which is the opposite. So it's a pretty simple philosophy. And at the end of the day, all you gotta do is don't follow the herd too much. And if you are, in some ways you should be doing something that's somewhat unique. But don't get me wrong, retail loved stocks, like herd mentality, can be extremely beneficial in the short term. Just don't have the herd mentality of thinking that it's going to change the future and it's a 20-year hold, because I can guarantee that 99% of those aren't. But yeah, that's all for this.